Alright, for this video I want to go over sample form 8582 for the passive activity loss limitations. And in this scenario we're going to have a taxpayer that has some investments in partnerships that are passive activities, but he also has a rental property where he actively participates in the management, and so he's going to be claiming this special allowance for rental real estate activities to claim a loss up to $25,000. So we're going to look at the 8582 here. It's 2 pages. We've also got the full 1040 for the taxpayer, so we'll cover all the forms and schedules that are going to be relevant, and that's certainly going to include the Schedule E, to where we report the rental income and expense, Schedule E page 2, and then the 8582 as well. Lastly, we've got just one slide here covering some background on the 8582 and passive activities, and specifically this rental real estate active participation allowance. So when we talk about passive activity losses and income, passive activity losses cannot be used to offset income from non-passive activities. That's the general rule. Now, there are certainly some exceptions to that, and that's what we're going to focus on in this video, is one of those exceptions. So passive activities come up in really 2 ways. So the first is you have an interest in a trade or business activity where you do not materially participate in that business. That would be a passive activity to you. The other is if you have an interest in a rental activity. Now, rental real estate activities, regardless of your participation level, are described as per se passive activities. So when you are confronted with a rental real estate type of activity, basically the go-to rule is immediately, this is just a passive activity. It doesn't matter what you're doing to manage that property. However, there are some exceptions, right? And so the first exception is that rental real estate professional, or just real estate professional election. Now, most taxpayers will not be able to qualify for this. The real estate professional election is quite a high burden to meet. I've got some videos covering it in more detail with some more elaborate examples, but most people will fail these tests and will not be able to qualify for that real estate professional election. The second option, which is the subject of this video, is the special allowance for active participation. So this is a much easier burden to meet. So if you as the taxpayer are an active participant in the rental property, you can deduct up to $25,000 of your losses against your non-passive income, subject to certain AGI limitations. Now, active participation, what does that mean? Well, it's much less stringent than real estate professional, and it's even easier to meet than the material participation standard. So if you think about this kind of on a sliding scale, real estate professional is the most difficult, material participation is somewhere in the middle, and then active is towards the bottom. To be an active participant in the real estate rental, it really only requires making a few management decisions a year. So if you're approving a new tenants, approving repairs, and so when you think about a rental property, right, you might have one new tenant a year. So to approve a new tenant, not a lot of work on an annual basis. And so most taxpayers that manage their own rental properties will meet this active participation test. All right, so let's have a look at the fact pattern, and then we'll get into the return. So in our fact pattern here, we have John, taxpayer. He bought a single-family home as a rental property investment. He paid $275 for the property, and he financed 80% on a 15-year note. Now, during 2023, the activity generated a net taxable loss of $4,959. John is also invested in 2 partnerships, which are passive activities. John has some other income from wages, interest, and dividends, and his total modified AGI is $86,033. All right, so let's have a look at the 8582. So before we get into this, we should first look at the Schedule E for the rental income and expense. So John completed his Schedule E. This is a single-family home. He had $22K in rents, and here we have all the various expenses. And so the net loss from the activity reported here on line 21 is $4,959. So that is the net rental real estate loss for this activity. Once that number is established, then we can go back to the 8582 and complete the passive activity loss limitations form. So the 8582 is 2 pages. Part 1 is where we summarize some of this data, but before we complete Part 1, as it notes here, we have to complete Parts 4 and 5 before filling out this schedule. So if we go down, Part 4 is where you report passive activities from real estate, and Part 5 is where you report other passive activities. So if we'll look at Part 5, just to get this out of the way, the other 2 investments that John has are in Partnership Fund 1 and 2. These are passive activities to him. We can see the current year loss for these activities was $3,000 for Fund 1, $950 for Fund 2. We have some prior year unallowed losses, $12,000 for this fund. Fund 2 at $6,200. So the overall gain or losses is the $15,000 and the $7,150. Now, because John doesn't have any other passive income, all of these losses attributed to these entities are going to be unallowed. So we look at the total cumulative losses. The unallowed portion is the full amount. And so the allowed loss for these activities is 0 for the year. And so we can see that as it's reflected in Part 2 of Schedule E. So Schedule E, Part 2, we have the Partnership Fund 1 and 2. And then on rows A and B down here, we can see in the passive income or loss section, we're reporting zeros for both because neither of them we are able to take any of the passive losses. So all of those are unallowed. And so now that that's done and completed, we can have a look at how we complete the rest of the 8582 for those rental real estate activities. So lines 2A, B, and C, so these amounts are flowing through from Part 5. So if we go down to Part 5 again here, we've got the current year net loss, $3,950. The prior year unallowed is $18,200. All right, so that's how we're getting these values on 2, B, and C. Now in Part 1, lines 1 and B, line 1B should flow through from Part 4. So if we go to Part 4, we have the activity from the rental property. So we've got the name of the activity. We just listed the house address. The current year net income, we have no current year net income. We just have a net loss. So the net loss coming through from Schedule E was $4,959. We have no prior year unallowed losses because this is a brand new activity. And so the overall gain or loss from the whole activity is $4,959. Now, once you have the totals for the current and the prior years, we report these values back up in Part 1. So column B here is reported on line 1B, and so that flows through up here to line 1B. So now that Part 1 is completed, we've got a total losses of $27,109. Now the prompt here is if line 3 is a loss and line 1D is a loss, go to Part 2. So we've got line 1D is a loss, line 2D is also a loss. So we can go down to Part 2, which is the section for the special allowance for rental real estate activities with active participation. So in Part 2, line 4, we enter the smaller of loss on line 1D or 3. So 1D is $49.59. That's the actual loss from the rental activity. Line 3 is $27,109. So the smaller amount is going to be the $4,959. Now line 5, we enter $150,000 for the year. That's the AGI threshold. So in other words, if our modified AGI is at or above 150, we're not going to be able to claim any of this special allowance. But in our case, our modified AGI is below that. It's $86,033. And so our modified AGI, we're calculating our income without factoring in the loss for those rental activities. So we've got wages of 85, interest and dividends, add all those up, and we're left with our modified AGI of $86,033. So we subtract line 6 from line 5, and we have $63,967. We multiply by 50%, but do not enter more than $25K. So if we multiply by 50%, we'd have roughly 30 some odd $1,000, but we can only deduct up to $25,000. So we put the $25,000 ceiling in there. Now, line 9 asks us to enter the smaller of line 4 or line 8. Well, the smaller here is going to be the $4,959. So the loss that's going to be allowed here is the $4,959. So total losses allowed section, we add up all the income, if any, from lines 1A and 2A. We don't have any. So the total losses allowed are going to be an addition of lines 9 and line 10. So we've got line 9, line 10, and then we have a $4,959 loss. So now once we have this number and we know, okay, this is attributed to the rental real estate activity, we can go back up to Schedule E. So Schedule E, if we scroll on down here to line 22, we can see the deductible rental real estate loss after limitation, if any, coming through from 8582. So the total rental real estate loss that we had was $4,959. The amount that's going to be deductible after factoring in these limitations is $4,959. So our total rental real estate loss is going to be $4,959. We don't have any losses here in Part 2 from the partnerships because all of these are unallowed. But the loss that we will have is reported here on line 41. And so there's our $4,959 figure. Now, once we have that figure, that can flow back up to the Schedule 1. So Schedule 1 for our additional income, we have line 5, rental real estate, other income for partnerships, S corps, and so on, coming through from Schedule E. So there's our $4,959, and then ultimately that flows up to page 1, and we can see it's reflected here as a reduction in arriving at our AGI. So everything said and done here, the rental real estate loss that we incurred from Schedule E, remember this is a per se passive activity. So John has to test, okay, this is a passive activity loss, so it has to remain passive and can only offset other passive income unless I meet one of those exceptions. So do I meet this active participation exemption? Do I maybe meet the real estate professional? And that can get it recharacterized. Now I think what's important to remember is this is still characterized as a passive activity. So this is still reported and tracked on the 8582, right? Just like all these other losses. So when we look at losses that are tracked on the rental activities, now in this case, we were able to use the special allowance, the entire amount. If he had losses of, let's say, $50,000, the max he could have taken for the year was $25,000, and there would have been a carryover. But this still remains a passive activity. I think that's really important. This isn't magically now a non-passive activity. What they're saying is this is a passive activity related to real estate, but you are going to get this small little carve out, this $25,000 allowance that's available just for real estate investments. All right, so that covers it for this video. Hope that was helpful. Any questions, feel free to leave a comment below. And as always, I appreciate you watching, and I look forward to seeing you on the next one. Thank you.